Okay, let's just jump right in. We're starting this deep dive with what has to be one of the most brutal stats in finance.
Mm-hmm.
Why is it that 95% of retail traders are just perpetually stuck? They're trapped in this cycle that the source material calls hope and cope.
That 95%, it's not just a number, it's really the price of emotional trading.
Right.
And the core issue, which a fantastic thread by Herman Trading points out, is that this huge majority, they treat the charts like a casino.
A casino, that's a strong way to put it.
It is, but it's accurate. They're making decisions based on a hunch, a feeling.
Yeah.
Trying to, guess where the next candle's going to go.
So if you're just going with your gut, you're basically gambling, just with a fancier user interface.
That's it. Exactly.
Our mission today, then, is to contrast that high-risk emotional stuff with the disciplined approach of the successful 5% of the people the source calls market engineers.
Yeah.
We're going to try and grab their blueprint and figure out how you make that jump from being a gambler to an engineer.
And that jump, it's not just about learning a new chart pattern. It's a whole cognitive shift.
The mindset shift.
Completely. That's why this is so valuable for you, the learner. The whole reason for the gap in success is that the amateur is trying to predict. The pro, on the other hand, they operate with a system, a mechanical framework.
And the main takeaway we're chasing here is that real, repeatable success means getting rid of the heaviest weight of all.
Human emotion.
Human emotion. So to do that, these pros, they wait for something they call their signature.
Right. Their signature. It's a set of conditions that are totally non-negotiable.
Which is the opposite of the retail trader who's just, chasing the price, hoping they gets the right direction.
Exactly. The engineers, they're completely passive. They're spectators until the market confirms a signal they've already defined ahead of time.
So this creates what the source calls a strictly binary edge.
Yes. Strictly binary. I love that term. There's no gray area at all. A pro is either in the trade because all three parts of their criteria are perfectly aligned, or they're on the sidelines. A spectator.
Yeah.
Literally just sitting on their hands.
I think that's the part that's so radical. For most people, sitting on your hands while the market is flying feels like you're losing money.
Right.
You're missing out.
It feels like you're missing the opportunity of a lifetime.
But the professional has built a system where doing nothing is the default. And actually doing something, actually placing a trade, requires this incredibly high bar of proof.
Exactly right. Because that freedom to predict, it's so seductive. But the cost is, blowing up your account.
Right.
The market engineers get that the only way to force that binary discipline is with a mechanical framework. It has to be so specific that it just removes all subjectivity. It filters the emotion out for you.
Okay, so let's get into the guts of that machine. What are the specific parts that have to line up to create this signature?
The whole thing is built on reacting to what the big institutions are doing. It's not about guessing. It's about reading their footprints in the market.
And the source breaks that down into three key technical components.
3 components, yeah. And this isn't about, drawing random lines on a chart. This is about reading the evidence that big money leaves behind.
So let's unpack these 3 elements. I think we need to go deeper than just the definitions. We have to understand the institutional logic behind each one.
Absolutely. Think of this as the professional's checklist. 0 ambiguity, non-negotiable.
Okay, so first up is displacement. The source calls this clear institutional intent.
Right.
And it argues this is a really aggressive, sudden move that's just too big to be caused by retail traders.
This is the market tipping its hand. It happens fast and it's violent. When you see displacement, you're not just seeing buying or selling, you are seeing institutional aggression.
Aggression. So what does that mean in practice?
It's a move specifically designed to liquidate the other side, to hunt stop losses and absorb liquidity just so they can get a massive position filled.
Ah, okay. So retail buying is more like a slow build. This is a shockwave.
It's a shockwave. It is the first undeniable sign that the real momentum has started.
That distinction is so important. It's not just a big candle. It's a move with, malicious intent. It's meant to shake out the weak hands.
Precisely.
Okay, so that's element 1. Element 2 is the order block, defined simply as the footprint of the big money. But what is that, really?
The order block is basically the last little area of opposite price action right before that huge displacement move happened.
Okay.
So if the displacement showed you the institutional intent and power, The order block shows you their presence. It's the spot where they were accumulating their large orders.
So it's like the launch pad.
It's the launch pad. And importantly, those areas often have trapped orders that need to be defended or retested later on. They're critical structural points.
I see. So the order block is where the foundation was laid.
Mm-hmm.
But the third element, this is where the actual mechanical edge is. The FVG or iFVG.
The fair value gap.
Which is described as the magnet for price rebalancing.
This right here is where the engineering mind really separates itself from the gambler.
How so?
When that big displacement move happens, it's so fast and aggressive that it creates an inefficiency in the price.
Net inefficiency.
Yeah, the price moves so quickly it literally skips over certain price levels. It leaves a gap, a void. That void is the FVG.
Okay, but why does that gap matter? Why does the market care enough to go back to it?
Because of mechanical necessity. The big financial institutions, they need balanced two-sided order flow to run smoothly. When an FVG is left behind, it's a sign of huge one-sided action.
So it's an imbalance that needs to be corrected.
Exactly.
Oh.
Price is fundamentally drawn back to that imbalance, that FVG, to fill the void, rebalance the books, and pick up any orders that were left behind. So the professional's entire edge is, as the source says, waiting for the return to the iFVG.
Wow, that really connects all the dots. So the displacement shows the direction, the order block shows the point of origin, and the FVG shows the mathematically probable point where price has to return. The professional isn't predicting. They're just reacting to where the market mechanics demand a rebalance before the next big move.
You've got it. The market makes a move, it leaves behind its fingerprints, and it creates a liability. That's the FVG. The engineer just patiently waits for the market to come back and pay that debt before they get involved.
This is a system based on institutional supply and demand, not retail psychology.
Not at all.
And this whole concept gets super clear when we look at the example the source gave, the 9-to-Q setup.
Yes, the London session example.
For our listeners, 9-to-Q is the NASDAQ futures. It's known for being really volatile, so it's a great testing ground for a mechanical system like this.
So in that example, you see this massive, aggressive displacement happen right at the London Opens. The institutional shift, price just rips upward.
And right there, that's the moment of conflict, isn't it? Because that surge causes what the source calls retail FOMO at the bottom.
Oh, yeah, the fear of missing out. Amateurs see that and they just pile in, chasing the move higher and higher.
But the professional, following their signature framework, they just ignore it.
They ignore the surge completely. They see where the FVG was created, that rebalance point, and they just wait. They only react to the rebalance, not the initial explosion.
And this is where that discipline test really kicks in, because waiting goes against every human instinct we have.
Every single one. And the source was really honest about their own internal struggle during that exact trade. They said their gut was screaming at them to jump in, to chase it.
That's the emotional old me, right? The gambler who just wants that instant gratification of being right and catching the whole move.
Which is almost impossible and definitely not repeatable. And that's the moment of truth. If they had followed that gut feeling, they would have entered way too early.
And probably gotten stopped out or had to sit through a painful drawdown.
Exactly. But the rules took over. The mechanical framework, the rule was binary. No displacement plus an FVG rebalance equals no trade, period.
So they had to sit there for, what was it, 40 minutes?
40 excruciating minutes, yeah. Just watching the price move away, knowing that their plan was to wait for it to come back.
And the result, I mean, it just says it all.
It really does. By being obedient to the system, they avoided that emotional entry that would have been a potential 1R loss, R being 1 unit of risk.
And instead,
by waiting for the signature to fully form, they got a clean, high-probability entry that resulted in a 3R win.
3 times their initial risk. And that story just perfectly delivers the key takeaway. Discipline isn't about being smart. It's about being obedient to your own rules.
The signature framework does the smart part for you. The human's only job is to execute, to click the button when the lights turn green.
And if they don't?
You wait. There is no middle ground.
Which brings us to this pretty revolutionary shift in how you have to think about winning and losing. It's so tough for people to wrap their heads around.
It is. In the casino model, winning feels good, losing feels bad. Simple.
But for the market engineer, that entire emotional frame has to be just deleted.
Completely. The professional framework sees wins and losses as, and I'm quoting here, simply data points confirming your edge.
Okay, wait, let me challenge that for a second for the listener. So you're saying if I follow my rules perfectly and the trade is a loser, a 1R loss, you're telling me that's a success?
Yes.
That feels so counterintuitive.
It is, but it's the only path to long-term success.
Right.
If you followed the rules, the loss is a success because you validated the system, you trusted the process.
And a win that broke the rules.
That's a failure.
Okay.
If you chased FOMO and got lucky, that's a failure because you just reinforced a bad habit. You corrupted the data.
So you're aiming for process mastery, not outcome mastery on any single event.
That's it. The goal isn't to be right on this one trade. It's to execute the system perfectly over a huge sample size. The source mentions a 100 setup sample grid.
Right.
You execute with robotic precision because you know that over 100 trades, your only real ally is probability. The math has to play out.
Which leads us to this final, really powerful theme. The market doesn't reward your predictions. It rewards your systems.
That's the ultimate transformation right there.
Real wealth, then, comes from disciplined obedience, from just adhering to the machine, not from the ego boost of being right about the direction.
You give up the ego of predicting, and in return, you get the consistency of a machine.
And the final outcome of mastering that process.
Yeah.
The language the source uses is so strong. It says, by focusing on the setup, the P&L, the profit and loss, will eventually stop being a choice and start being an inevitability.
It's a profound statement, isn't it?
It really is.
It suggests that once you remove the random variable human emotion and replace it with the controlled input of the framework, the outcome is, well, it's structurally determined. It's just math.
So for the learner, even if you never place a single trade, this is a deep dive into the power of having a mechanical, repeatable system in any high-stakes environment where emotion can wreck your decisions.
Any field where consistency is the goal.
So this deep dive, it's really laid out that painful but critical transition. To get out of that 95% hope and cope crowd, you have to stop guessing. You have to adopt the rigid structure of market engineering.
You focus only on the alignment of those three pillars: displacement, the order block, and that FVG rebalance.
And that rigidity brings us right back to the ultimate psychological hurdle. If the source says that P&L becomes an inevitability, and that a loss that follows the rules is actually a success, that leads to a big question. At what point does a trader's confidence in their system actually overpower that deep, instinctual human feeling of hating to lose money?
Is that robotic precision even achievable for the average person? Or is it only for people who can truly accept losses, not just intellectually, but like emotionally, as just necessary data to feed the machine?
That's definitely something to mull over.
It is.
The machine only works if the human operator agrees to trust the spreadsheet over their own gut. Thank you for sharing this source material and for joining us on this deep dive from the casino floor to the engineering blueprint.